Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So the US Central Bank basically paused, and not just did any kind of pause, did a hawkish pause. Now what does this hawkish pause mean? Well, basically they didn't hike rates, they didn't raise rates, but they came out sounding a little bit more aggressive on future rate hikes. How did they sound more aggressive? Well, one, you could argue that in the press conference, they were not talking about any rate cuts. They were talking about leaving the door open for future rate hikes. And most importantly, in the economic projections, you had the interest rate for this year move up from 5.1% to 5.6%, basically penciling in that we could see two more rate hikes this year. Now, it's not guaranteed, right? Anything can change. The probabilities that the markets are trying to predict with this rate hike can change also, and the Fed can change depending on the data, depending on where inflation goes. But Jerome Powell did come out, the Fed did come out and say that, hey, we are going to continue to monitor the data. We're going to continue to monitor inflation. We need to get inflation down to the 2% target. He reiterated that in his, not only in the statement, but also in the press conference, saying that, hey, we need to get to our 2% target no matter what, which means that they're going to continue to keep conditions tight even if they decide to pause. Now, they discussed about the July meeting also. Now, they paused in the June meeting. They said July meeting will be live. What does that mean? That basically means that they could raise rates or not raise rates, again, depending on the data. If the jobs data that comes out in July and the inflation data that comes out in July ends up being more on the hot side of things, more hotter than expected, then yes, you can expect that the Fed is probably going to come in and hike rates. And the markets are pricing in basically a 60% probability of rates being raised in the July meeting. Now, on top of that, the Fed, during the press conference, said a lot of things that were hawkish. That's where you get the name of the hawkish pause, basically downplaying of any dovishness, downplaying the idea of even any rate cuts or any easing in the markets. Basically talking about that, hey, look, we're looking at core inflation, and according to the core PCE numbers and the core inflation numbers, they're still up there and they're still sticky and they're having a tough time to come down. And we saw that also with the core CPI data, even though the headline number came down, which I discussed in my last video, check the video there. But even though that number has come down, the core number is sticky and is staying elevated at the current levels around 5 point something percent. So this is basically telling the Fed that they have to continue to keep conditions tight. And if people are going out there spending or doing anything that is contributing to higher inflation or higher prices, then they will go ahead and press on the brakes even further, right? Now, is it also a surprise that they moved rates from the projection from 5.1 to 5.6%? Some can argue that not really, because we heard Bullard in the past talk about that we could see rates even go as close to 6%. So you had some Fed members who were more on the hawkish side, even Mester, more on the hawkish side, saying that, hey, we still need to do more. We still need to do more to combat inflation and bring inflation down. So you could argue that that could also be another reason for why the stock market basically shrugged off as soon as Powell came during the press conference, shrugged off whatever happened during 2 p.m. and rallied back up. You could argue that, or the other argument you could say is just a simple mania in the markets, basically calling the Fed's bluff that, hey, they're done. They're completely done. This is the pause, and this is great for the markets and the economy, and up we go, right? Even though that may not be the right trade, the right thinking, although it may be the right thing short term, but medium term, it may not be the right thing, especially if this mania fuels in more asset price inflation and the valuations don't make sense. And if Jerome Powell is looking at this, he clearly doesn't want financial conditions easing and going, with the stock market going higher and higher and higher, and people feeling they're rich all over again and spending all over again, which will basically fuel inflation, which will thus bring him to raise rates further and hike more if that were to happen. Now, another thing that Jerome Powell said during the press conference is also that he is not only looking at core inflation, but also the housing component and housing component in the rent tends to be a little bit hotter than he expected and a little bit more stickier than he expected, which basically tells you that, hey, we got to do something about this. We're watching housing very closely, which means that we're going to keep rates. If we decide to even not hike, we're going to keep rates at high elevated levels before we start bringing it down, because we want to bring inflation down. And he talked about rate cuts a little bit, saying that that's way out of the way. We're not even thinking about rate cuts right now. We want to bring inflation down, because if they're thinking about rate cuts right now, then that would shoot inflation back up. Or that just simply means that something is truly breaking in the economy, something has broken, things have got worse and off, and the unemployment rate basically skyrocketed. That's when you can see the rates being cut and coming down. But I don't see that this year unless there is a very hard landing or ugly recession. Now, what's really interesting also from the economic projections is also the unemployment rate, how they're projecting the unemployment rate. Now, notice that this year versus next year. So this year's unemployment rate is around 4.1%. Next year is around 5%. So 4.1 to 4.5, basically a 0.4% increase in 1 year. Now, historically, when you look back, whenever you get a 0.4% increase in the unemployment rate, since 1970s, when you look at the data, it tends to signal a high risk of a recession, a very high chance of recession. So Jerome Powell is basically telling you, the FOMC is basically telling you through that number that the unemployment rate's ticking up and expected to tick up by 0.4% next year, which is basically signaling that they see, yes, the recession happening in 2024. Now, the GDP numbers, he didn't really play with that much. It doesn't look as weak, especially with the unemployment rate moving up higher. What's the reason? I mean, the narrative that Jerome Powell has been trying to push is this soft landing and saying that, hey, we can get, prices to come down while the jobs are not so worse off and while the economy is still doing somewhat, fine. Right? So the soft landing narrative. But I don't think that's going to happen because, again, since 1970s, whenever you see a 0.4% increase in the unemployment rate, you tend to see a high risk of a recession. So let me know what you guys think. Comment below, subscribe, hit the like button and the bell icon to be notified in the next video. Let me know if you think they're going to hike 2 times or more. Do you think they're going to hike rates to 6% or higher? Do you think we're going to see 2% inflation? And if so, how will we get there? Leave a comment below and your thoughts, and I'll see you guys in the next video. Cheers. Bye.